Hi, Professor Barati here. I want to go over with you today the statement of cash flow, which is this week's topic. The statement of cash flow, as you can see on this screen, is one of three major financial statements that are required by FASB and considered generally accepted accounting principles. So, the most prominent statement that almost everyone's familiar with is the income statement, which we learned about throughout class, and the balance sheet, or the statement of financial position as it's called. And now we get to the cash flow statement. The cash flow statement is essentially the income statement and balance sheet analyzed on a cash basis. So think of it as our income statement and our balance sheet basically flow through our trial balance throughout the year. And through that trial balance of debits and credits and different columns and adjustments, these accounts basically go into accounts that create our income statement and accounts that create our balance sheet. What's different about the cash flow is very few accounting systems can actually create or spit out a cash flow statement, unlike the income statement and balance sheet. It's pretty much a spreadsheet exercise still. Therefore, your knowledge of the income statement and balance sheet can only help you understand the cash flow statement. Essentially, the cash flow statement is a culmination of the income statement and the balance sheet reconciled to a cash system. So it basically says, what would our income statement and balance sheet look like if we only recorded transactions when we paid or received cash? So a generally accepted accounting principle income statement is based on the accrual method. So as you know, we are recognizing revenue not when we just get paid for it, but we're recognizing revenue when we ship our goods. We might have to wait 30 or 45 days for that to collect that revenue, but we recognize revenue when we ship. We recognize expenses that go with that revenue, regardless of whether we paid cash or not for those expenses. So, essentially, to produce an accurate income statement, we cannot use cash method accounting. We have to use the accrual method. We recognize revenue expenses when they're incurred, not when they're paid. Then comes along the cash flow statement, which basically says, what would our income have been had we only recognized expenses and revenues when we actually collected or paid cash? And the reason why this is an important statement is investors and external uses such as lenders and management itself needs to know how well a company is managing its cash. The interesting thing about this statement is that net income, although a great barometer of a company's performance and a great metric based on a company's performance, after all, most stock prices are determined by earnings per share and net income. The cash flow statement tells a very, very true story. It basically tells us how well management has managed cash from its operations and what it did with that cash after operations. So let's get to the statement, and while I will explain how the numbers got there, I will also explain the interpretation. The cash flow statement starts with the section cash flows from operations, which is the first section of the cash flow statement. Now, every company or profitable for-profit company has operations, whether it's a manufacturer, a retailer, a service company. They are building things or selling manufactured goods or selling services. There are operations behind those products and services. So what are those operations? They are obviously materials that go into products, labor that go into products, overhead that supports those products and services, things like your factory or your office building. Operations also include your back office, like your accounting department, your HR department, your marketing department, and so on. Your repairs and maintenance, all that is operations. Without any of those functions, you could not generate and service the goods and services of your company. So those are your operations. Now, what the statement of cash flow does, it tries to explain how those operations turned assets and liabilities into cash, predominantly mostly assets. And it's concerned about current assets and current liabilities. The reason why it's concerned about current assets and current liabilities is because that is your working capital. And working capital is defined as current assets minus current liabilities. So obviously, if that's a positive number, you have positive working capital. And it's an important feature that a company should monitor, and it's an important metric that people who want to analyze the efficiency of a company should look at. So working capital plays a very important role in the success of a company, just as much as net income. It would be hard to say that net income generates working capital, but also you can't really generate net income without adequate working capital as well. So they're both dependent. They both feed off each other. So the statement of income works with current liabilities and current assets, current liabilities, the working capital function, because they represent the liquidity part of the balance sheet. How solvent a company is, how liquid it is, how quick it could turn sales and receivables into cash and pay its bills via accounts payable, and so on. Without that constant successful cycle of solvency and liquidation of products into cash, you can't have working capital. And without adequate working capital, the only other way to survive is to take on huge leverage and debt. So, the statement of cash flow starts with net income. Net income is not cash. It's a accrual accounting method number. It basically says, here's our revenues, here's our expenses, here's our operation expenses, and here's our non-operating expenses, and we get this number called net income. It's a barometer of how much income a company made, but it is not a barometer of how much cash the company generated. We start with net income because it's the best and only real place to start. The goal of the cash flow statement is to take net income and determine out of that net income, what would it have been if we used a cash basis? What in that net income is cash that would increase it and cash that would decrease it? So every cash flow statement starts with net income, and this is the indirect method. We add in depreciation and amortization expense because depreciation and amortization expense is an expense that reduced our net income. But it's simply a paper expense. We didn't pay cash for depreciation, and we don't pay cash for amortization. They are accounting charges against net income. There's no cash basis there. So technically, our net income, if it were to represent cash, would have to increase because depreciation and amortization reduce net income, but not on a cash basis. So we add that back to net income. The same theory goes behind this amortization of debt. Amortization of debt, as you learn, could be the premium or discounts on bonds payable that get amortized over the maturity of the bond. And so, therefore, we're not literally cutting checks to pay for that. It's an accounting treatment. So our net income gets reduced by that, and so that gets added back to net income. Let's go right to the current assets section. We won't dwell too much on deferred income tax and stock-based compensation. Essentially, again, they get added or subtracted because they're accounting entries and not real cash entries. At that point, we go to our balance sheet. Once we basically determine what on our income statement is not a cash outlay expense and should get added back to net income, we then go to our balance sheet and look at our current assets. The current assets for this company, Mattress Firm, basically are accounts receivable, inventory, and prepaid expenses. Now, when you're looking at a cash flow statement and you see accounts receivable as -7, it does not mean that accounts receivable went down by $7 million. It's the opposite. Accounts receivable went up $7 million, but cash flow went down by 7. So the -7 represents an increase in accounts receivable. And here's what's going on behind that. When a company sells a product on trade, meaning it has to wait 30 days to collect cash, essentially is recognizing revenue, say for $1,000. That revenue is a credit, and the offset to that revenue is an increase in accounts receivable. The company did not technically collect that cash. On a cash basis, your net income would have been 0 because you didn't collect the cash. So if accounts receivable goes up by $7 million, what it means is we billed out more revenue than we collected in that period. So if we billed out more than we collected, that means we recognize more net income on our books versus what we collected. So if receivables go up by $7 million, revenue and thus net income goes up by $7 million on an accrual basis, but on a cash basis, we collected $7 million less than we billed. Therefore, receivables go up, net income has to be adjusted downward to reflect the cash basis. Had receivables gone down by 7, you would have seen this number as a positive $7 million, adding back to net income. If receivables go down by 7, that means we collected more cash than we billed. So our net income would have been diluted. It would have been too low on a cash basis because we collected more cash. The reverse would have had to happen. Let's go to the inventory line. The inventory is saying that inventory went up $11 million. Therefore, the working capital impact on cash is a minus $11 million. Remember, we are starting with net income. So these changes are the impact to net income, not the impact on the actual accounts. So if inventory is minus 11 million, it's a minus 11 million because it went up by 11 million. Now let's stop and think. When inventory goes up by 11 million, the opposite side of that transaction is the cost of goods sold, because inventory flows through our system as cost of goods sold and is an expense to the revenue. that cost of goods sold gets subtracted revenue to create a gross profit. Therefore, when inventory goes up, the offset to that is a lower cost of goods sold. So let's envision our income statement here. A lower cost of goods sold means we recognize more profit. Our expenses are lower. Because we're recognizing more profit, we have to reduce or adjust our net income down by that $11 million. Because our inventory went up, our cost of goods sold went down, we showed too much profit on a cash basis. The same goes for prepaid expenses. Let's use prepaid insurance as an example as part of that prepaid expense. What this saying is prepaid expense went up $1 million. Therefore, our working capital impact on cash flow reduces our net income by $1 million. When our prepaids go up by $1 million, it means that we paid more in expenses than we've amortized. So the amortization did not keep up. We didn't amortize the full $1 million in that period. But we paid cash for it, and we put it on a prepaid account, and we're going to expense that prepaid over a period of time. The cash flow statement isn't going to wait for that expense. It basically says if prepaids go up, you paid for it, it impacts cash flow in a negative way. Let's go to our current liability section of our balance sheet and review those accounts. Here we have accounts payable, accrued liabilities, other working capital, and they have a segment here, other non-cash items, which they don't disclose in this particular example. Accounts payable increased by $13 million. Therefore, we add that $13 million back to our net income for a cash flow basis. When accounts payable increases, the offset to that are expenses. So when your accounts payable person gets an invoice and creates a payable for $13 million, the offset to that payable is usually going to be debits to expenses. That's what the cash flow indirect method is assuming. That debit to the expenses reduces our net income. Therefore, if payables go up, the cash flow statement is saying expenses went up and were charged against net income. Our net income on a cash basis was reduced by expenses that don't necessarily get incurred. So we have to add that $13 million back to net income. Accrued liabilities, again, when they go up, the offset is to be assumed to be on the expense side. If expenses go up on our P&L, they reduce our net income. But we didn't pay for them. Therefore, our net income is overstated on an accrual basis. So we have to add them back. We have to add them back to net income. So I believe I misstated. On when accrued liabilities go up, expenses go up, and then on an accrual basis, they understate our net income, and therefore we have to add it back for cash flow purposes. Other working capital is probably assumed to be other accrued liabilities, which is the same theory that I just mentioned. To summarize, cash flow. Summarize net income. Go to your income statement and evaluate non-cash outlays, which is always going to be depreciation and amortization. They get added back. Another common adjustment to net income that you do not see in this particular company's cash flow, but it's quite common that you will see, are gains or losses on sale of equipment and investments and things like that. If a company has a gain on a sale of equipment, that gain adds to net income, what you want to do is subtract that gain because it's just a paper gain. It's not a cash generated gain. Conversely, if a company has a loss on the sale of equipment, you want to add that loss to net income because, again, it's just a paper entry to balance your books. So once you're done with the income statement, you go to your current asset section of your balance sheet. And that's where the indirect method comes into play. Essentially, if current assets go up, cash flow goes down. If current assets go down, cash flow goes up. Current liabilities, if current liabilities go up, cash flow goes up. If current liabilities go down, cash flow goes down. So you probably might be confused by saying, well, if my current liabilities go up, how does my cash flow go up? Because I've incurred more liabilities. Again, quickly to remind you that when accounts payable goes up, the offset is expense. That expense reduces the net income, but we didn't pay for it. So we recognize expense on an accrual basis, but we're trying to convert this to a cash basis, so we didn't pay for it. So if liabilities go up in our balance sheet, on our balance sheet, essentially we're adding to our net income for a cash flow basis because we've recognized expenses that we didn't pay for. We're essentially using our vendors' money for that period in time. So net income plus adjustments to net income plus changes in working capital, meaning changes in our current assets and our liabilities up or down, gives us a total of net cash provided by operations. So this company's operations, the furniture business, generated $82 million in cash flow from operations. This is where things actually get a little easier from a logic standpoint. Unlike working capital now, it's more straightforward. It's more direct rather than indirect. What did this company, Mattress Firm, do with their $82 million they generated from operations? Well, they took $34 million and they invested in property, plant, and equipment. And they took acquisitions, net of acquisitions, of $8 million. That's just for this year. As you can see, in trailing 12 months, there was a very large acquisition, and that acquisition was made recently on a major competitor of theirs. So in case you're wondering why that big number stood out, they made a very big acquisition. But in this particular year, out of the $82 million of operations, they took $42 million and they invested in property, plant, and equipment, okay, which is part of their operations, and they did acquisitions of $8 million. However, they borrowed $40 million, and the net cash provided by financing, which is this section right here. Net cash provided or used for finance activities. Now, just getting back to the investment side, it's very straightforward. If you buy property, plant, and equipment, you're using cash. So cash goes down. If you're doing acquisitions, you're buying acquisitions, you're using cash, cash goes down. They borrowed $40 million in long-term debt, probably to help finance some of those acquisitions. But they paid down $5 million in long-term debt. So it could be a combination of a refinancing as well. The company also issued $110 million worth of common stock. So they increased their common stock in their equity section of their balance sheet, and they got $110 million in cash. That money was used to help probably pay off some of the long-term debt. It's usually not the best thing to see on a cash flow statement to see a company issue common stock, because that means they are adding more outstanding shares to their common stock pool, which is going to affect their earnings per share later on in the years. So as you know, in the prior chapter we just did earnings per share. If you issued more common stock, your earnings per share, the shares are the denominator, which dilutes your earnings per share fraction. So it's usually not a good sign to see that. Net cash provided by financing was $4 million. So the change in cash is $44 million. Most of that was generated by operations. The cash at the beginning of the year was $4 million. At the end of the year, we add the net change in cash of $44 million to the beginning, which explains why cash went up $48 million. So cash went up $48 million from $4, predominantly because of cash provided by operations, which is what you want to see as an analysis. You want to see cash really being generated by operations. They reinvested some of that cash in property, plant, and equipment for themselves. And then in the finance section, they paid down debt, but they raised common stock, and they issued new long-term debt to help pay it down. Another section that is widely used, it's not in the cash flow statement, but this particular statement likes to isolate what's called free cash flow, a very important metric. Free cash flow is determined by taking the operating cash flow of $82 million and subtracting the investment in property and plant and equipment to give you free cash flow of $47 million. That's an important metric used in the investment world today, because what it means is the company has $47 million of free cash that it has to pay down debt or pay dividends after its operations and its investment in property and plant and equipment. The property and plant and equipment section is basically comes off of operating cash flow because it's an important section of the cash flow. That's what companies need to reinvest in their equipment for future cash flow generation, to keep their company up to date with modern equipment and so on. So as you can see, looking across the years, this company has been able to generate some healthy cash flow from operations. With the exception of most of the years, the acquisition of $840 million, they basically had to issue debt to finance that. Obviously, cash flow from operations was enough to self-finance a large acquisition, so they had to go into more long-term debt. They did not, obviously, issue more common stock. They probably couldn't, and so on. So that's a good overview of the cash flow statement, how to generate the numbers, and basically what it means in terms of the health of a company. Thank you.